The name is Bond, James Bond. How often have you heard this? But in real life, taking shortcuts in creating currency can lead to disasters. And hence, we have a bond in the monetary policies that allows for a two-step process, like you have this two-factor authentication that will prevent a huge disaster. Interestingly, this concept of having a two-step bond process actually came up from England, where we have James Bond. Did you know, twice a week the Indian government releases a new Bond movie, and in the case of US it is actually thrice a week. If the theater is packed, the reviews are great, then people trust the rupee, people trust the dollar, and they want more tickets. But if it's half empty or everyone demands free popcorn, it's a sign the audience isn't buying the plot anymore. This movie business is no longer just a Bond movie. It is a referendum and a monetary policy. Did you know that every dollar or a rupee that is printed today first has to pass a market test, a sort of a global feedback loop? Before a single note hits circulation, governments have to sell bonds and see if anyone actually wants their debt. That's the world's quiet daily referendum on trust. When this loop breaks, when money is printed without asking the market, history shows us the result: hyperinflation, chaos, and currencies that turn into confetti. When a government skips the bond market and directly prints, there's absolutely no price discovery. No one saying, hey, this return isn't worth the risk. There's no signal about the real demand for that currency. The government has no early warning that it is over-injecting money. The first feedback only arrives much later if this two-step process were averted, and rising prices and collapsing trust will be the eventuality. By the time inflation surfaces in this case, it's already spiraling. Well, just like a car without brakes, and you only know you're going too fast when you're about to crash. So let's discuss the feedback loop of the two-step process. Step 1. The government issues bond or IOUs. In India as well as the US market, the government that issues the bond is also called as the Treasury Department. Step 2. There are market participants, which are banks, pension funds, insurance firms, sometimes even high net worth individuals who decide whether to buy these bonds based on the interest rate offered, of course, the trust in the government stability, and 3, the inflation expectations. This becomes an instant feedback signal. If investors refuse to buy at low yields, the government must raise the interest rates, make the bonds more attractive, or ensure cut spending. This reaction mechanism keeps both the money supply and the confidence in check. When a government skips the two-step bond process and instead chooses to print currency directly to meet its need, the eventuality has been seen in history. Number 1, Weimar Germany, 1921 to 1923. After World War I, the German government owed massive repatriations. Instead of raising taxes or borrowing, it printed marks directly to pay debts and wages. The result? Hyperinflation. Prices doubled every few days. By late 1923, a loaf of bread cost 200 billion marks. People literally used currency as wallpaper or fuel. So the lesson is, money supply exploded without matching output. The mark totally collapsed. A similar story happened in Zimbabwe, 2007 to 2009, Venezuela, 2014 to 2019, Yugoslavia, 1990s. We can pay tribute to the Bank of England for innovating and coming up with a two-step process in 1694. This is where the modern system truly began. What was the key innovation? The British government, short on cash for war with France, chartered a private institution, the Bank of England, which is in today's equivalence is a central bank, like how we have the Reserve Bank of India or the Federal Reserve. Instead of printing notes directly, the government issued bonds. Investors subscribed to those bonds by paying gold and silver. The Bank of England issued banknotes backed by those bonds. And hence the two-step model was born. The government raises money via bond issuance. The central bank creates money based on those bonds as collateral. This separated fiscal policy or spending from monetary policy or money creation, a firewall that modern economies still use.
Treasury bonds have now reinvented themselves in making themselves relevant even in the crypto world. We will talk more about this in the next section.